Hi, Luke. Okay, now he's muted again. Unmute, please.
Unmute.
There you are.
There I am. Perfect.
Hi, how are you, Luke?
Good. How are you, Dale?
Good. You know, I looked, and the last time we talked was 2017. It's a long time ago.
You know what? Sorry, I just it bumped me out for about 5 seconds there, so I missed
Okay.
the last 5 seconds of what you said.
Yeah, the last time we talked was 2017.
Is that right?
Yeah, so I checked it out, and so what has been the biggest event in your opinion since we last talked in 2017?
That's a very good question. I would say it's probably two things in succession. I think the first was the repo rate spike in September of 2019 that forced the Fed to begin growing their balance sheet again. And then I'd be remiss if I didn't say followed up by the COVID crisis in March of 2020 and the Fed response to that.
Yeah. Okay. All right. And so now we're all up to date, and you did it in 2 sentences, very efficient. And now I want to ask you, Luke, tell us where the forest is, because we're all looking at trees. We're all looking at COVID numbers, employment numbers, when's the Fed going to taper? So everyone's really looking at individual trees, and I want to know where you think we are in the, looking at the whole forest. California's forests have burned down. There is no forest. You can't find trees or a forest in a lot of areas here. So,
unfortunately,
and I did go to your, your series. You send out videos to new subscribers. I subscribed, and I remember your thesis about negative real rates being the key, and your thesis and narrative that everyone thinks that negative yields right now are extreme until you bring up the World War II example of where they were here in the US. So you're still on track for much lower nominal rates and real rates that are going to move towards where we were in World War II?
Yeah, I think it's a great way of framing the question where's the forest, and with everyone looking at trees, and I think that's exactly where the forest still is, which is people say, Luke, I need you to tell me your thesis in 15 seconds or less, and it's real rates bottomed last August on the 10-year at negative 1.1%. Negative real rates are just nominal rates minus the rate of inflation. And that was consensus, was that they had bottomed and that this was going to be a typical recovery as we've seen post-war. And certainly in the last 40 years. And our view is that real rates likely are going to need to go in the United States at the 10-year level to -5 to -10%, and possibly even further is the big picture. And then you get into the why, and it's simply the levels of debt. There are so many things, so many factors that are different now than they've been for 40, 50, 60, 80 years. But most investors and most traders are still assuming the same playbook that we've had in the 2010s and the 2000s and the 1990s and the 1980s. That, I think, is the big picture. Is I think we've never really seen anything like what we're seeing before, but the analogs that are closest are, like you said, in the mid 1940s, immediately after World War II, and maybe in the 1920s as well.
Okay, so we had deflation in the 20s, and your point about the debt, since you and I last talked, that has risen exponentially, especially after COVID and all the rescue legislation and supporting individuals in the economy because it was no fault of their own. That was their whole, there are a lot of things that aren't our fault that cause hardship in people's lives, but first time in U.S. history, people have been kind of compensated for it. So does that exacerbate what you were talking about pre-COVID with all the new debt that's come from COVID rescue plans, the fiscal stimulus that we've had in the last couple of years?
In a word, yes.
Yeah.
When you look at, for example, in the 1920s, which was the last time you had what I would call a global sovereign debt bubble, you had the sovereign debt of the six biggest industrial powers of the time: U.S., U.K., Germany, France, Japan, and Russia. Over the ensuing anywhere from 2 to 12 years, fell in real terms against gold by 60 to 100%, with two of those six hyperinflating their currencies to basically zero, being the Germans and the Russians. And obviously there's political issues to go alongside that. But I think when you look at your question in terms of how we reacted to this crisis, I think it's important from two standpoints. Number one, your summary is exactly right, and I'll probably be borrowing that in future conversations, because I think it's a brilliant way of framing it, which is hardships have come and hardships have gone throughout human history, but this was really one of the first times where people were compensated for hardships out of their control. For example, in the Dust Bowl in the 30s, and there were no compensation. People packed up their cars and took what they could and went to California. And so this time we did. And so that, again, kind of alludes to my initial point that we're seeing things we've never really seen before. But that then also ties into the second point, which is when we look at the 20s example, the United States in the 20s and 30s did have deflation until we devalued the dollar against gold and began deficit spending under FDR. Then we went into World War II. That's always inflationary. So, but another way that I think people are misapplying history, and many investors and traders are misapplying history, is the United States was the world's biggest creditor at that point. We were in a role that is now occupied by China. And the role that the U.S. occupies is more like Germany, England, France, kind of rolled up into one after World War I, where we do have the global reserve currency. The UK had it then. There were challenges to it then. There are challenges to it now. Those countries were deindustrialized by war. We have been deindustrialized by trade policy over the last 25 years. So there's some things that rhyme, but when the bottom line to it is when you put factor one, which is this is the first time in recorded history, or certainly in a long time at the very least, that we are compensating people with future debt to pay them now, to compensate them for hardships out of their control, combined with the fact that we are in this debtor twin deficit position with financiers who are no longer buying enough of our debt or outright friendly. It sets up a very structurally inflationary / weak dollar period, because ultimately it sets up a period of time where the only financier of debt, the biggest marginal financier of U.S. deficits, is going to have to be the Fed.
Interesting. And let me ask you this too: is there a similarity with, although it's not being caused by war, although some people would say we're in we're in World War III, it's a Cold War right now with everyone, but were there supply chain issues similar in World War II, where we had to turn American citizens turned in rubber and different materials so they could use it for making arms and things that our Army could use and our Marines could use? So similarities with supply shortages. Is that another similarity with World War II that we're having now, not because of war, but supply chain issues?
I think so on some level. I think similar to World War II, similar to World War I. I think the World War II example is a really good example of what happens when you have to supply yourself, and that's something that's really been forgotten, I think, by most Americans, because, to be blunt, most of the Americans that lived through that at an adult age are dead. And so They're
Yeah.
gone. I mean, I remember finding the old ration stamps in my father-in-law was when he passed on a decade ago. They were his mother's ration stamps from World War II for, just like you said, for sugar and for cotton, something else, and
Yeah,
gasoline, right?
and people forget because they're so cool, woodies, right? They forget that it wasn't just by design; it was by necessity.
Yes.
That to use less metal to build a car, they started using wood paneling on the side of some
Oh,
cars.
I didn't know that. Oh, interesting.
Yeah,
Yeah.
yeah,
Oh,
the
that's
woodies.
interesting. So yeah,
So
so it's that's a great
go
point.
ahead. Yeah,
No, I was going to
we'll
say
throw our
is
surfboards on top of it, buddy.
yeah.
Yeah,
You can make anything cool, right? I mean, when cotton
yeah,
prices got really high, 5 or 8 years ago, all the dress shirt makers came out with the new light cooler style, right? Of like, hey, they were selling it to you as if they were doing you a favor because it was, more breathable cotton. But the reality was cotton had risen so much that, a shirt was going to be $50 and they weren't going to be able to retail it across most of the country. But no, it's this. We are so, as Americans, having the global reserve currency as it's been structured for the last 50 years, we are so used to dollar equals goods. We've never even
yeah.
had to give it a second thought. And there's never been this, I have dollars, where are my goods? And we're, for the first time in at least 50 years, and probably more like 80 years to your point during the war, okay,
Yeah.
I have dollars. Where are my
But
semiconductors? Why can't I get my
yeah,
car? Why can't I get my chicken at Chipotle? There's I think it's a
everything.
signal. Yeah.
Yeah, everything. I mean, Americans are not used to shortages. And I mean, I've ordered a few things online and had delivery dates, and then delivery dates were postponed because they didn't have it in stock, and isn't it also our our we don't stock inventory anymore like we used to. It's like as needed. I forgot the term.
For the just in
Uh,
time. Yep.
yeah, just in time, and now just in time is not enough time.
It's
So
it's it's
go ahead.
exactly right. No, it's exactly right. And I think too, some of the you've not only stretched supply chain, so you've taken inventory out of the system, you have taken inventory out of the system by concentrating warehouses, right? So Amazon has, I don't know what the number is, 5 or 10 major warehouses that are sort of their big ones around the country. So they've consolidated, all in the name of efficiency. Everything has been in the name of efficiency, but it's not been in the name of resiliency. Because if you're looking at a scale, you can have really, really efficient, but then you're going to be not resilient at all, or you can be really, really resilient, or you're not going to be efficient at all. And so we used to have a balance, and I think the original Cold War with the Soviets helped force us to keep that in balance because we needed to be able to make stuff ourselves just in case.
Yeah,
And over the last 20,
but when
25
China
years,
came in, that changed.
that changed. So we stretched our supply chains out and we went hard to the side of everything for efficiency. And now we're finding out we're not very resilient. Even, for example, in our domestic industries, we have consolidated our protein processing down to
Yeah,
shockingly few plants, to the point where when COVID hit last year,
right.
there were
Great
periods of
point.
time where there were meat shortages because the workers had COVID and there was only, Tyson only has 5 plants or whatever it is throughout the whole country. And so you run into these spot shortages. You saw it with lumber with some of the processing capacity as well last year, which contributed to the run up there. So it's the supply chains are very fragile.
Yeah, and we don't, because we don't have the manufacturing base you said. Most people don't realize that if on our power grid, some of these huge transformers that we don't make them here. They're made in China, and if one of these blow out, it could take multiple months and maybe years to replace it from China, and that's if relations are good.
And that's if
So
relations are good. That's if COVID's
yeah,
good. And I think that's another sort of big forest that people in the trees in this debate of inflation or deflation or inflation deflation. To me, it's a fascinating cognitive dissonance in many traders' minds and investors' minds that point A they start with in their mind is we're going to get tougher on China. This is a Cold
yeah,
War. And I think that's the right one to start with. But then point two in their minds is we're in a secularly deflationary time frame because too much debt is deflationary. And they are forgetting the real world connection between debt and real world goods and fiat currency and real world goods. And if you're going to pick a fight with your biggest supplier, you're going to have shortages. And when you have shortages are never, ever, ever deflationary.
Right. And it either is, higher wages.
No. And we're
That's
seeing
not
that pass through, too.
transitory. You can't give someone a pay raise and then a pay cut.
Well, and the usually not. No, the private sector can lay people off, or the private sector can do some things to manage that. To me, what's been particularly interesting in recent months, and this has been part and parcel to the steps we have taken to ease the hardship out of everyone's control, is the U.S. federal government is almost 30% of GDP. If you look at annual spending of the U.S. federal government relative to GDP, it's all-time highs. And what we're seeing now are wage increases, big wage increases coming from the federal government to their employees. And people say, well, high prices cure high prices. And that is true with one exception, which is high prices don't cure high prices for the federal government when they can print the currency. They'll just print more.
Right.
And they will then chase inflation, wage inflation, goods inflation. The government unless the US government is willing to shut itself down for lack of goods, then high prices won't cure high prices. High prices will just feed on themselves, because the federal government at 30% of GDP will not let themselves get shorted for lack of printed dollars. So I think we're in this very sensitive area now where you're seeing all of these factors we just discussed more frequently. And they're sort of stuck from a policy standpoint as a result, where you can delay paying. I'm sorry, go ahead.
Yeah. Are you familiar with that milkshake theory, which dollar bulls use, that, before the dollar falls apart, that there's going to be, this huge demand for dollars because of emerging market debt, et cetera, that's going to create a liquidity squeeze and drive the dollar index up to 120 before the collapse. Can you see any way that we could have that one move because I would say that most people are fundamentally bearish a dollar for, pretty obvious reasons, and very few bullish a dollar. People are embarrassed to come out and say they're bullish a dollar. Do you know what that milkshake theory is again,
Absolutely.
Luke?
Yeah, absolutely. So it's effectively that there's so much dollar debt outstanding that we're basically a giant short squeeze of the dollar in sort of the last, in crisis. And we've seen that play out in I would say for brief periods of time.
Right.
For example, last March of 2020, where we saw the dollar spike up to whatever it was, 102 or 103 on the Dixie at the time. And I agree it could still super spike. I think increasingly as we look back in time that March 2020 was the super spike. And the reason I say that is, and a reason why I have always had a healthy, friendly debate with my friend Brent Johnson, who was the original espouser of that milkshake theory, has been, I remember a friend of mine asked me, Luke, how can you be bearish a dollar with so many people short dollars? And basically, hey, how can you be against the milkshake theory? I said, simple, there's nobody more short dollars than the US government, and they can print dollars. And he just paused and said, oh my gosh, that's exactly right. And that's why, and we saw it in spades. So my view was, you could see that dollar spike. I don't know where it could spike to, but at some point along that spike, what's going to happen is US markets are going to crash so severely that you will start to see treasury yields rise in a US stock market crash. And at that point, the federal government will step in, the Fed will step in and do whatever it takes, and that will be the end of the dollar super spike. And I think most people thought that would happen at 110 or 120. I thought it would be much sooner. And what we saw in March of 2020 was that Dixie got to 102. The S&P was already down nearly 20%, which was more than I thought it could fall before this would happen. But beginning on March 9th, 2020, Treasury yields started rising rapidly as stocks were melting down. And so from March 9th,
until the Fed stepped in,
till the Fed stepped in. And so to me, that's why I say I understand the theory, I agree with the theory, but I increasingly think as time goes on, that March, that March 2020 was the super spike, the 102 to 103. Now, to be clear, at any given point in time, we could still get that. So if we use an extreme example, if the Fed came out tomorrow and said, we are going to take our $8.2 trillion balance sheet down to zero by Christmas 2021, and we're also going to raise rates to 3%. I guarantee you the dollar's going to a lot higher than 120. And I shouldn't say I guarantee, but it is highly, highly likely that the Dixie's going to 150 or 200. So that theory is always on the table from a purely economic standpoint. Now, my point is when you blend the political economy with the pure economics, it seems highly unlikely, because the flip side of that is the Dow's probably going to, I don't know, 5,000. The S&P is probably going to break the lows of 2008, et cetera, et cetera. And that's a problem, because that's basically the economy at this point. The S&P, the equity market cap at 200% of GDP, where we are in the United States right now, means the stock market effectively is the economy. So you basically, the economy would crash. The U.S. economy would crash, stocks would crash, global economy would crash, dollar would be up a ton. But I think politically, that's not really on the table anymore.
Okay. That's interesting. Do you think that perhaps, and I look at the dollar and, I'm kind of in agreement with you now. We've had this nice little bounce here from the beginning. Everyone came into 2021 very bearish a dollar. Do you think this little bounce sideways move has been enough to shake out dollar bears, or could we pull back and maybe make a rally back towards, I know you don't make market calls, but could this dollar, let's just call it stability, carry on for a bit longer before we get into an acceleration phase on the downside? And do you think Powell is going to be renominated, or is Yellen going to push for Brainerd? And is that going to be really the key? I mean, Powell sounded like Brainerd Friday anyway. So is that also part of Fed policy? Is Powell wanting to be renominated next year?
Yeah, so on the dollar, from the short-term perspective, I think a lot of it comes down. I think they would like to keep it stable for the moment. And we've kind of seen, I don't know, if you map the cadence of Fed governors against where the dollar's traded, once it gets up into 93 plus, we got into 93 and a half or whatever, and all of a sudden you get Kaplan, who's been a pretty hardcore hawk, saying, well, maybe I need to, and so I think they are trying to manage it in a range that is creating stability elsewhere in the markets. And I think that range is probably, it seems like it's, between, call it 91 and 93.
Okay. Yeah, I think we could pull back to 91 here over the intermediate term and then make one more run, kind of have something like this from a lower level that lasts, maybe into October, end of the year. How does oil fit into this mix? Same type of thing. We're going to run into shortages. What a change a year can make from that having negative prices for crude on that technical futures situation to do you see any global slowdown that might ameliorate some of these commodity prices that have already had tremendous runs, like copper and oil and agricultural commodities? I mean, the Fed can't print corn. So
No, they can't.
What are you thinking here with the commodity complex?
I think the commodity complex I think it's really interesting on two fronts. So I think you have to look at the policy front, where in the short run, we've got some political hiccup as it relates to debt ceiling and stimulus and whatever. But ultimately, the big gear to this thing is the U.S. needs to inflate its debt away, as we talked about at the start of the show. And so you've got, they're going to have to spend a whole lot of money. The Fed's going to have to effectively monetize a lot of that, or else it causes as many problems as not spending the money at all. And that's a really good monetary background for these commodities. And then when you layer in particularly certain commodities like oil, a lot of the metals, I think behind the scenes, there are some growing supply demand problems in oil in particular, but I think more broadly as well, where there has been in a lot of the metals underinvestment over the last 5 to 10
Yeah,
to 12
the
years because they've just
mines.
been, yep, they've been so burned by what has happened. And I
Yeah,
think in oil in particular, if you look at the global production, there's been very little marginal production of oil other than U.S. shale since roughly 2005 to 2006. And we're now running into problems growing U.S. shale any further without prices going much higher to incent that production. And so I think there is both a monetary and a really a structural, excuse me, a really a structural supply support for
right.
higher commodity prices, starting with oil. And once you start with oil, oil's really the master commodity to them all, right?
Yeah,
As energy,
yeah. It's in
that
everything.
it's in everything. That feeds into everything.
You
So I think
even need it to make the green economy start up. You
oh,
need it for everything.
that's exactly
Yeah,
right. I always joke around. If
yeah,
you give me enough oil, I'll grow you 150 bushel corn in the parking lot of a Walmart.
yeah.
So,
I wanna wrap it with what do you think about, when I look at 10-year yields here, longer term, Luke, and that there is, unless we do get that stock correction, I could make a case for, maybe 210 on the 10-year if we come out of here and maybe have a good number Friday. I'm not sure what's going to happen, but is this going to be a great buying opportunity in bonds if yields head up to say 2% on the 10-year? Is that a buying opportunity with notes as we start to head back down towards negative, lower negative real rates, according to your thesis?
well, for me, I think bonds from from an investor standpoint, I would be, we just went
Hesitant.
through just a structural underweight simply
Okay.
because I think that they're going to have to inflate this debt away, and I think from a trader's perspective, I do think that that I think it's a market where the Fed wants to make it appear like they are not managing that market while managing that market. And they have done as we saw yields looking like they were going to break out back in April.
Yeah, right here.
We saw a great job of all of a sudden talking about, hey, taper might be on the table. And you
Yeah.
saw this quarter of jawboning from the Fed, quarter plus of jawboning. I think they were pretty panicked as they got to April. I think they were surprised by how fast and how successful they were at generating inflation by monetizing massive federal deficits.
And they forgot about the bond vigilantes that are out there. It wasn't them that took yields from 50 bips to 170. So
Right.
it was the market that did that, right?
Market took it on them, and I think that surprised them. And it's challenging because I've always joked about this as the, describing the Fed trying to ride two horses with one rear end, which is they need to inflate the debt away, but they need to convince the bond market that they're not going to inflate the debt away. So for me, I wouldn't be surprised actually if that 1.7 range isn't the line in the sand on the 10-year in terms of
Okay.
when, where I won't call it yield curve control, but yield curve control-esque behavior would escalate. So far, they've been able to do it with jawboning and with some of the things they have done in terms of just with what's happened with the stimulus rolling off and what have you. But again, it's those two opposite needs. The U.S. government needs to get the debt down to get it to a level where the debt is sustainable for the Fed to normalize policy. But to do that, it needs to financially repress these bondholders with these significantly negative real rates. So to me, that's I'm watching in the short term from a trading perspective, just what happens with the debt ceiling, because as you remember from 2011,
right,
if we get a bunch of drama with that, you could see yields go lower first. But I think the 10 years are really increasingly going to be basically a managed market. I think that's where we'll see a Japanification is in the 10-year over time.
Yeah, so they've taken the bond market away to central planners.
Yeah, unfortunately.
From us.
Yes, unfortunately.
Those bastards. Oh, excuse me. Anyway, Luke, great interview. It's really, I enjoyed talking to you again and hearing your hearing where you think we are with the forest. And, here's your website. I just want to show it to our viewers and attendees and people to watch a video later. And you do offer, some nice videos that explain what you and I have been talking about today. So I encourage people to, go to Luke's website right here, fftt.com, right, Luke? With a hyphen
FFTT-LLC.com.
LLC, yeah. So we
Yeah.
have to get the tax classification in there too. So Luke's Limited Liability Corporation. Good time to have limited liability into this financial world right now. So thank you so much, Luke, for coming in and sharing your views and giving us some of your time today to
Thanks for
edify
having me
our
on.
community. Yeah.
Absolutely. Thanks for having me on, Dale. It was great being here again, and
Yeah.
apologize. I was a little late getting on technical difficulties on my end.
It's great. I'll be in touch with you, and really appreciate you sharing views a lot, that make your research pretty unique. I really think that some people had their eyes open today. So thanks for doing that, Luke.
You're welcome. Thank you.
Okay, everyone, you could join the team in 10 minutes on the Morning Edge. See everyone tomorrow for Turnaround Tuesday. Here's Luke's website. Check it out. And remember, don't just count your yields, count your blessings. And we'll see everyone tomorrow. Adios. And thanks again, Luke Gromen.